Now, let's get into the investment strategies that will actually allow you to achieve FIRE. There are many types of calculations and strategies out there, but the most famous one is the 4% rule. It says that each year you are allowed to sell 4% of your shares safely because the growth of the market will make up for that. However, ask any retiree that got into retirement with that 4% rule during a prolonged bear market, and you will find out why this likely isn't a good idea. Here is the math behind it. Let's say you have $1 million in your portfolio. You are allowed to sell 4% of it, meaning $40,000. You have decided that this is enough for you to live, and so you decide to retire. However, the market drops by 30%. Now you have $700,000. If you want the same $40,000, you have to sell 5.7% of your portfolio. Oops. And if by some chance we enter into a so-called lost X number of years period and you don't have cash flow, things get ugly. This phrase is used for a set of time in which the stock market hasn't gone anywhere. You will sometimes hear it as a lost decade in the media, but it can be for any number of years. Here is a visualization of what that means. It's a chart of the S&P 500 index that supposedly always goes up and is inflation adjusted. Now, granted, it does go up over time, but check this out. 30 years, then 24 years, then 15 years of lost periods. Will your retirement start being such a period? No one knows. It's a gamble. It's a gamble with your life. Can you afford that? Imagine what this famous 4% rule will do to your portfolio in such periods. You will get wrecked. Also, have in mind that the original study that came up with the 4% rule calculated it for a 30-year retirement period. If you pursue FIRE, when you couple that with the increasing lifespan due to healthcare tech innovations, then you might actually be looking at 50 or more years of retirement. And in those situations, big drawdowns or years of flat markets become even more likely, and I certainly don't like that. You see, I would much prefer to calculate my FIRE number based on the income that my assets are producing instead of fixed numbers for withdrawal like 4% rule or a total asset amount of, let's say, $1 million that I have to start selling. In my opinion, the only safe way to do it is through income from your portfolio, not the 4% withdrawal rule. Imagine owning a mix of dividend-paying stocks, ETFs, and real estate that pays you rent, and the combination of those cash flows equals your FIRE number. Wouldn't that make you way more comfortable? You have $1 million. You have, for example, $60,000 per year coming from it. You get the $60,000 and your principal, the $1 million, stays the same. In time, if you picked quality assets, both your income and principal will increase, at least with inflation or even more than that, slowly making you even richer while you're enjoying retirement. And in case you have picked higher yielding investments that give you more current income than you need, but don't grow as much, you can reinvest the difference and create your own growth. For example, if you need $60K and you receive $80K, you reinvest $20,000 every year, and even if those original $60K stay the same because your dividends aren't growing, the reinvestment of those $20,000 will slowly increase the $80K to $82K, then $84, etc. Either way you choose, this is certainly the investment strategy I would pick and is the best one in my opinion. If you want help with setting it up, I have a free masterclass where I do a deep dive into my investment strategy and philosophy, and I talk about investing for passive income that eventually can allow you to achieve FIRE. You can find the link for it in the description. Now, one thing you need to be careful with are estimations without margin of safety. Please don't think you can retire at the exact number of passive income that your expenses are. If you need $2,000 a month to live a minimalist lifestyle, for the love of God, don't retire on $2,000 monthly passive income. You must have room for error and unforeseen events. Cars break down, health issues come up, roofs start to leak. You can't calculate those things. It's not like a once-in-a-year expense where you divide it by 12 and you're done. I, for example, paid over 15,000 euros to fix some issues with my teeth. I'm not gonna do that every year. I'm not gonna do that even every decade. In fact, the problem has been solved for good. But had I not done it, my dental health would have been in serious jeopardy by the time I was in probably my 50s. However, I could not have seen this happening 5 years prior. In my opinion, it is best to have at least 1 year worth of emergency funds in cash and at the same time a bit more than your monthly needs as passive cash flow in order to have a safety margin. For example, to support the life you want to live, only spend around 70 or 80% of your passive income. And if unforeseen event comes, you use your emergency fund and then refill the emergency fund with the remaining 20%. Or if you have opportunity to reinvest your income when quality stocks are at a discount, reinvest the remaining percentage and live a bit more modestly in order to increase your investments. You will figure the exact details and numbers. These are just suggestions. But never plan retirement right on the edge. Always have a margin of safety. You don't know what life will throw at you. Speaking of not knowing, I just discussed negative unexpected events. But let's think positively. With the advancements in healthcare tech, and if you take care of your health, it is entirely possible that you might live on average until you are 90 or 100 years old. Now, this is positive for you, but negative for your capital. Because if you pursue full fire, that means that you won't be working and contributing, but only drawing from it. This is where my thesis of retiring only on passive income from your assets with included margin of safety comes. If you add to that the internal growth of the dividends or rent you receive or reinvestment plan I described, then you can be a lot more assured that your funds will last you indefinitely. This is not the case if you simply have a fixed pool of assets or cash in the bank and you withdraw from it. You might have calculated it will last you 30 years, but what if you live 50? No one knows when their time is up, and it would be a shame to have to look for a job in your later elderly stages of life after being out of the job market for 30 years. This video is part of my complete guide I did on how to achieve financial independence, retire early, and all the investment, psychological, and social aspects you need to consider. To find out what the full strategy is, click on the video that has just appeared on your screen.